All right, what is up, and welcome back to How to Invest in Commercial Real Estate. We're back.
Welcome back.
I say that like it's been a long time every time, but
it's only been a week.
We've kind of been on a roll, actually.
Yeah.
But anyway, we are back for another episode of How to Invest in Commercial Real Estate. And today, we thought it would be good to just kind of go over some terms, some commonly used.
Yeah, we've done it before, but it's been a long time. And, you know, it's interesting. Even investors that have been investing with us for, you know, let's say a few years, they'll get on the phone with me and they'll say, hey, tell me about this new investment. And I'll start going and rattling off terms. And they're like, hey, slow down, wait a second here. I don't know what you're saying. And so that's why we thought, hey, if you're interested in commercial real estate terminology, we're going to roll through a bunch of terms today after Braden gives us like a couple of updates.
Yeah, some updates.
We bought some stuff.
Bought
some more stuff.
Yeah, we closed this week, right? No, last week.
Last week, yeah, it's going to come out next week. So last week, we bought 3 deals in Texas, 2 in Amarillo, 1 in Victoria, Texas, outside of Houston. Those were bundled up in one massive investment. I think it was our biggest investment, biggest equity raise. Yep. It was a $5 million equity raise. We had an amazing partner out of Austin, Rooster Capital. Super excited to have them involved. Yeah. Our Fort Worth office, Andy Jackson, had a massive impact in getting this deal across the finish line.
Yeah, they did great.
Yep.
A repeat lender on this deal. And yeah, a ton of leases to go renew, a ton of under market rents. We've got a $2 million renovation on these 3 properties. So this is definitely a value add retail play.
Yeah, it's a heavy lift for retail for us. A lot of parking lot work, brand new roofs, parking lot lighting, painting, just tons of stuff.
Yeah, we're already getting bids on that. Already getting started.
So then when is the next launch? Are we launching next week? A new deal next week, I think?
This week. Yeah, this week.
Okay, this
in like
week.
a few days, you should get an email. It is a deal in Lansing, Michigan.
What's the equity raise on that? Do you know?
What, you tell me.
I think it's, I'm gonna say $1.8 million. How about that?
Yeah.
It's in that ballpark.
1.76 is what I was thinking.
Okay.
Sounds right. If you haven't guessed it by now, most of the time when you buy commercial real estate, it needs some roof work and some parking lot work. Most of the time. A lot of the times, though, you would be surprised. You do the inspections, or you hear that it's an old roof. You know, maybe it's a 20-year-old roof. It's got a 20-year warranty. It's kind of old, right? You'd be surprised how long that roof will last with a little, minor repairs, a few $1,000s of repairs every year. Could go you a really long way. Some of these TPO roofs last forever.
Yeah, so the off topic here, but commercial roofs, they're flat roofs, and even when you put a brand new roof on, you still somehow get leaks. And then as long as you fix the leaks and are staying on top of it, then these commercial flat roofs, they do last a long time, but they cost a lot of yearly maintenance. And so pitched roofs are way easier, but they're just not aesthetic for commercial buildings, so we don't get to use them all that often. But all right, well, let's dive in today to the subject, guys. This is going to be a blitz round. So Brian, hit us.
Okay, so the first term we have, and I'm going to give some of the abbreviations too. So NOI. So when we talk about NOI, net operating income.
Yeah, this is the most important one, to be honest.
Number 1 on the list.
Yeah, it's basically your free cash flow before any debt service.
Yeah, and just guys, hone in on the word net, because everybody gets confused about income and revenue and expenses, and where's all this is saying is you've got your gross income or top line revenue. You're going to subtract all the expenses it takes to run the property, everything it takes.
You don't subtract capital expenditures, right?
Yeah, I mean, that's getting complicated, but yeah, if you're going to replace the roof, that you wouldn't put that in this operating budget. So you get this net operating income. Like you said, it's free cash flow. And then after that, you're going to have to pay your debt service. So that's what this is.
What I like to say is we buy streams of cash flow and they give us a building for free. This is the stream of cash flow, the NOI.
Yeah. Okay, cap rate, also known as capitalization rate.
Yeah, this is the second most important one. It's almost like they're in priority. So NOI and cap rate, you have those 2 things, and then you get a value. So the NOI we just discussed is your free cash flow. A cap rate.
I got a way to say this.
Yep.
Since we just talked about NOI, net operating income, the cap rate is the multiple of the NOI that you're going to pay for the building. And so let's say it's a 10 cap deal, right? Your NOI is $1 million. You just take 10 times the NOI to get your purchase price. It's a multiple of the NOI to get your purchase price. There's several ways you can say it. So
yeah. There's market capitalization rates, a cap rate, as nobody really says capitalization rate, cap rate. There's market cap rates for each asset class and each submarket. So like a retail center in DFW has a market cap rate generally of like 6 to 6.5%, 6 to 7%, I would say.
Yeah, another way to say this is it's a ratio of your net operating income to your purchase price. What is that ratio? So the cap rate is that ratio. $10 million building, $1 million of cash flow, it's a 10 cap.
Yep.
Right.
This is where you enter the hateful YouTube comment right here that we're idiots and we don't know what we're talking about.
Yeah.
Now is the time to write that. We'll take a minute so you can write the comment.
Okay.
And we're back.
Next one, also important, the IRR, internal rate of return.
Yeah, so this is measuring the profitability and the rate of return of your dollar while it's invested in the deal.
Yeah. So it takes into account the time value of money.
Time value of money, 100%. Very simple layman's terms. It's your annual return that you made while the money was invested.
Yep.
If you gave me $100,000 and I had it for 5 years and we had a 20% IRR, your money doubled.
Okay.
Yeah, it's a little bit more, would be a little bit more than doubled because you're compounding each year. So how I try to relay this term is in your stock portfolio, if you say, hey, the S&P's averaged 9% a year, that's a compounded growth of the S&P. So if you had $100,000 invested in the S&P and you were getting a 9% average return, so that after that first year you have $109,000. Yeah. The second year, not the $100,000 doesn't grow 9%, the $109,000 grows 9%. So it compounds on itself. So I say it's the average yearly compounding return of the investment for commercial real estate.
Okay. All right. Cash on cash return.
This is the closest thing to a dividend. It's a dividend, right? It's the cash flow your money makes. It's the return on your investment. Yeah. It's not a return of your own money, right? It's not like you're getting your money back, but it's the money that your money is earning while it's invested. Your cash on cash.
Pre-tax cash flow.
It's effectively your cash flow divided by your investment amount. That's your cash on cash.
And so where the NOI is before the debt service, your cash on cash is the cash flow after your debt service divided by your original investment amount. So back to the example, you have a $10 million building. If you put down 20%, $2 million, then if you wanted to get, let's say, a 10% cash on cash, then that would be a $200,000 cash flow after debt service, which equals 10% of your original investment amount.
Okay. Equity multiple.
This is the total amount of money you made in the investment divided by the original investment amount.
Okay.
Yeah.
So if you invested $100,000 and you got back $200,000, you would have a 2x equity multiple.
Yep. And most of the time, equity multiples are given over a period of 5 years or 10 years. So in this world and in private equity, most people are trying to get a 2x multiple in 5 years.
So the question you would ask is when this comes in, and it's when you are using disparaging investment amounts, timelines, rates of return, to compare gross amounts of money that you're actually receiving.
Mm-hmm. Okay. All right. Gross potential rent.
If the property was full, this is the full with market paying tenants, highest and best use, the most money the property could make is the gross potential
at market
rent.
rates, right?
Yeah. This is really used in accrual accounting. A lot of massive institutional companies will calculate gross potential rent, and then they'll have a negative line on the income statement. That's called loss to lease or loss to vacancy or something like that. It's way more common in multifamily.
Yeah.
You really don't see it in retail accounting, especially in the retail accounting we do. We definitely don't use it.
So in multifamily, you're going to have the gross potential rent is 100% occupied, no rent concessions to the tenants, no free rent periods, none of that. And so you would get, that's what your starting point is, the gross potential rent. Now the next one, effective gross income. Uh-huh. So that's taking your gross potential rent, going back to the apartment example of 100% occupied. Well, this property's, we think it's going to be 94% occupied. And, to get tenants, we usually have to give them 1 month free, which reduces the rent amount by about 8%. And so it's the gross potential rent minus your vacancy, minus any credits free rent periods that you might have given the tenants.
Okay. All right. Next one's DSCR, debt service coverage ratio.
You're going to learn this one before you even get to buy the property because your lender is going to tell you all about it. For us, it's typically 1.2 to 1.25, and it is the NOI divided by the annual debt service.
And so does the lender, they're going to require something. Do they require that to be maintained?
Yeah, it's typically tested annually. Sometimes they test it biannually if you're new and they're just keeping a close eye on you. Sometimes they never test it at all. It's hit or miss, guys.
And what happens if it comes in underneath what they've...
If it's a private bank, they'll send you a nice, strongly worded letter and say, fix it. Obviously, you're trying to fix it anyway because you want to make more money. The reason they're worried about the DSCR is they want to make sure you're making well in excess of the mortgage payments so you can make those mortgage payments, right? So a bigger non-recourse debt company like Goldman Sachs or Bank of America or something like that, if you continually violate these covenants, a DSCR ratio is one of these covenants that you're going to have to maintain, they'll just take the property back from you.
Yeah, eventually what will happen initially is, let's say you have a DSCR of 1.25 and you're running at 1.1. That is probably a triggering event in your mortgage clause, and what they'll do is they'll say, hey, you're not meeting the mortgage coverage. We're going to sweep all available cash flow after the mortgage is paid to build up a reserve to make ourselves more protected.
Okay.
And so that basically that extra 10%, they're just going to start pocketing.
Yeah. And then when will they release the cash flow? Once you get back to 1.25?
It'll be in the covenants. But yeah, once you get back over it for, let's say, a certain period or something. Yeah.
Okay. Try hard not to do those loans, guys. They're painful. They hurt. The attorney's fees, the brain damage you have to go through. And then at the end to realize that they can pretty much do whatever they want. They collect all of the rent. They collect all of the money. They tell you how much money you can have, when you can have it, how you have it. It's freaking ridiculous.
They're tough loans, yeah. Okay,
operating expense ratio.
Operating expenses divided by effective gross income, really not used. Okay. Break-even occupancy rate needed to cover all expenses and debt payments. I would say this is used in a development case scenario.
Yeah, I mean, we're going through it right now, and I'm not going to be able to tell you what the exact number is, but we built brand new apartments. We're like 3% occupied right now. We just started leasing, but it's just a window on what is the break-even number. Is it 70, 80, 90% occupied? I mean, it's good to know, and it's something you can use to compare against different asset classes.
Debt yield is something very few lenders look at. Some look at it, again, more than others. It's just another metric that they can use to assess the risk of the loan.
We were talking about this. It seems like, what's the number they're trying to hit? Is it a 10? Debt yield of 10?
Yeah, sometimes they'll go down to 9.
9 or 10. So yeah, all it is your NOI divided by the loan amount. And it's a quick metric for the lender just to see, okay, how safe is this loan?
Okay. Appraisal, pretty obvious.
Yep, it is a professional estimate of a property's market value. It's 100% an estimate, and they're professionals in appraisals.
Yeah, and this next one, market value, basically if you took it to market and just let the market tell you what it's worth, that's what that is. It's pretty...
I have a good definition. It's what a buyer is willing to pay and a seller is willing to sell for. Yep. That's market value.
Yeah, duly motivated, as they say.
So replacement cost is pretty obvious, but why is that important?
Insurance.
Yeah, it's not that any one of these are so important. This is just to be aware of, because you're going to run into these terms, and when people are talking about them, you just want to know what it is. But yeah, insurance, they're going to say, hey, if a tornado wipes this entire building out, what is it going to cost to replace it as is in today's market? Because, you may not, it may be an older building and you may have paid one price, but to build this new is going to be a different price. And that's what the number you're typically going to insure, or your lender is going to make you insure to replacement value, because they want to get that income stream back up so they can get their mortgage paid.
Yeah, this is one I've been talking about a lot the past several years, not necessarily in the show, but just in terms of insurance, because when you think about owning a building for forever, you may have paid $1 million for a building that costs $10 million to replace now. So when you're talking about insurance, there's an argument that you should need $10 million of insurance. So with inflation skyrocketing and with COVID and everything, the insurance companies really started watching that replacement cost number, and they have their own formulas and data that they pull from, and they have pretty good replacement cost estimates that they'll mandate based on your lender.
All right, we got to roll quicker.
I was just thinking that same thing.
All right, hit us.
Basis.
When we say, hey, what's your basis in the property, that just means everything you paid for the property, plus your closing costs, plus your CapEx that you're going to spend, your total basis that you've spent.
Underwriting.
This is the process of evaluating the deal, testing it.
Yep.
Yeah, and I had a hard time with this because underwriting, when I first got into real estate, I was like, what does that mean, underwrite? But everyone goes about it differently. A lender is going to underwrite it from a lender's perspective. We're going to underwrite it from our perspective, but it's just evaluating the deal, all of its risks, all of its benefits, modeling the cash flows. That's underwriting.
Pro forma.
This is like the cash flow model, the business plan.
Projected. Yep.
Yeah, projected business plan or projected, numbers.
Rent roll.
The list of the tenants, lease terms, and the rent amounts. So when the lease expires, the name of the tenant, how much square footage they have.
Yeah, we pay a lot of attention to that when we're evaluating, right?
For sure.
Yep.
LOI, letter of intent.
Yeah, if you don't know what that is by now, just tune off.
Purchase and sale agreement, that is the governing document you're going to use to purchase the building. And it's a very important document because if anything goes wrong with that, it will dictate what happens. If the seller breaches, if the buyer breaches, if anybody commits fraud, that purchase and sale agreement is going to dictate how it goes down.
You're going to hear that as a PSA a lot of times.
PSA, yep. Mm-hmm.
LTV, loan to value ratio.
The loan amount divided by the property value.
It's easy.
Mm-hmm. Purchase price.
Leverage.
In the case of a refinance, it's property value. So actually, I think you're incorrect.
Yeah, well.
Yeah. You probably just can't read the paper. You don't have your glasses
Maybe.
on.
Leverage.
I can read it.
I can read it. Leverage is what you should be using.
Yeah.
It's borrowing money.
Other people's money.
To amplify returns. Oh, that's a good note. Yeah.
Amortization.
It is the length of time that you are paying back your loan.
Typically, we're looking for
25 years if you're getting bank debt, 30 years if you're getting institutional debt.
I met with the lender the other day, and they were like, yeah, we only amortize 15 years. I'm like, I think this meeting's over.
Yeah.
Yeah.
I mean, the bank wants you to pay as much toward the principal as possible, but from a cash flow perspective, it doesn't always work that way.
We got a 30-year am from Bank of America once. Hey,
nice.
Didn't get it again.
Balloon payment.
So there's terms, like it'll be a 5-year term, but it'll be a 25-year am. So at the end of 5 years, you'll have a massive balloon payment where you either need to sell or refinance the property to pay that lender back in full.
Yeah, I would say unless it's a life company or a HUD loan, you're always going to have a balloon payment of some kind.
Yep. Mm-hmm. Bridge loan.
Yeah, bridge loan is it's like a temporary short-term loan. That's why they say it's a bridge. Yep. Maybe it's a property that needs rehab or CapEx or stabilization, and so the lender won't put permanent financing on it because let's say the occupancy is 50% or something. So you get a bridge loan, and it's typically a higher interest, higher risk loan, short term. And
it's because shit happened.
Yeah. And so I would say bridge loans, be careful in taking out a bridge loan because once again, they usually have high fees, high interest because they're riskier for the lender. And if things don't go well in that short period of time, you have a balloon payment. It could be like 1 year or a year and a half. And then you're going to put yourself in a bind.
Yeah. Okay. Recourse loan.
Just means
and non-recourse loan. Let's do both.
Yeah, personally guaranteeing or non-personally guaranteeing. A non-recourse loan, if it goes bad, they can't come after me. A personally guaranteed loan, I personally guaranteed to pay that money back so they can sue me personally for repayment. We personally guarantee everything.
Yeah, we do.
We're going down with the ship, baby.
Triple net lease. Also abbreviated as NNN.
Yeah, that means the tenant is paying their share of taxes, insurance, and common area maintenance for the building that they are in.
Gross lease, as opposed to a triple net lease.
It just means they're paying you a stipulated sum, like $5,000 flat. It never changes. It is what it is.
So typically,
there's no variable
gross
amounts.
leases are in office properties because it'll be a common HVAC system. Everybody's kind of sharing the lobby and other spaces, and so they just do a gross lease because they can't break up the water and the sewer and the electric and all that.
Okay. Modified gross lease.
Something in between a triple net where the tenant pays all the expenses and the gross lease where the landlord pays them all. It's something in between. You've negotiated something in the middle.
Okay. Anchor tenant.
I mean, it's the main tenant.
Yeah, right. Yeah. It's the big
Not all shopping centers have
draw.
anchors, but like you'll hear the term grocery anchored center. So you have a big, $40,000, $50,000, 50 square foot grocery anchor tenant that's the main tenant of the center, and then all the little tenants that go with it. They would say that's a grocery anchored center.
What would be a shadow anchor tenant?
So I like to say we buy unanchored retail
Most of the time.
Yeah.
most of the time. Anchored is like a grocery store. I mean, a TJ Maxx is not an anchor by any means. We're talking about like 50,000 feet, like Joel said, like a massive grocery store. Like our Little York shopping center is anchored by this Hispanic grocery store. That's an anchor.
And a shadow anchor is pretty easy concept. Let's say you're buying a little strip center that's right next to a super Walmart.
Almost as if it's in the shadow of the super Walmart.
Yeah. And so they say it's shadow anchored because you're not buying the anchor. The anchor isn't coming along with your center. You don't own that, but it's in the shadow.
This is used car sales 101.
Yeah.
There was some shitty used car salesmen in real estate that came up with these, I guarantee it.
What's TI? We always hear TI.
Tenant improvements.
Okay.
Tenant improvements.
I would say most often in office and retail. And so you have a new tenant, and let's say it was a beauty shop, and now the new tenant's going to be, a chiropractor. They're going to have to refit the inside of that. So tenant improvement or TI dollars are negotiated between the two. Is the landlord helping out by providing TI dollars for the tenant to improve the space to their liking?
Okay. CAM.
Common area maintenance.
Okay.
It's like maintenance and repair to the building.
Yeah.
Yeah, it's all those areas that everybody shares. And so the landlord goes ahead and sweeps the parking lot, removes the snow and ice, maintains the light poles, and landscaping and all of that. And so that would be common area maintenance, and everybody usually pays their prorated share if they're on triple net leases, bills back to all the tenants.
Yeah. Rent escalation.
This is when your rent escalates.
Yeah. Option to renew.
Typically in favor of the tenant, and it's just a guaranteed option that they don't have to take, but they could take if they wanted to with typically a fixed rent amount for a certain period of time.
Let's do these next three together: GP, LP, and syndication.
GP, LP, and
so we syndicate deals, and a syndication is where we pool investors in order to buy a single property or a group of properties. If we do that, then we are the general partner. General partner takes all the risks. That's the GP. We're the ones setting it up. The LPs are the investors that we get to help buy the deal from us. They're called the limited partners or the LPs. They typically don't have any risk besides their initial investment. So that's those three.
Okay.
or control. The general partner is generally managing the deal and in control. The limited partner is limited in rights and control, and they're just along for the ride.
Yeah. Preferred return.
This is a guarantee that priority return to investors before profit splits.
Braden, he doesn't really know these terms, so he has to read it every time.
I'm trying to see how they word it.
No, you don't need to, because we know what a preferred return is.
Yeah, it's the first money out, right? We pay 8%.
To correct him again on live TV, it's not a guarantee. There's no guarantee. The preferred return says that we're going to pay a certain percent on the money before we partake in any of the profits. Now, if there's no profit, then we don't have to pay the preferred return. But if there is profit, that's up to like 8%, an 8% preferred return. 8% on the money goes to the investor before we get to partake in the profits.
Yeah. There you go.
What I said.
What he said.
Okay. The next three can be together too. Promote hurdle, and waterfall.
A promote is when the general partner makes money on the deal. That's the profit splits that Joel so eloquently described in preferred return for us.
Well, I didn't get into the profit splits. I just talked about the preferred return, but
That's what I said. You eloquently described when we talked about preferred return.
you said profit splits.
What's promote hurdle?
Ask Joel, man.
Yeah. Promote hurdle is the return that we need to get the investors in order to start making money as the sponsor.
Some would say that's the promote after you meet the promote or the preferred return. Once you meet the preferred return, then we can start hitting our promote.
And this is all part of the waterfall, right?
Yes. Waterfall is just a general term that describes the entire structure of promote and promote hurdles. And so, typically we'll give a preferred return, and then we give we have a split. But if we get to a certain IRR to the investor, a certain return, then we can change that split and say maybe the investor gets 70% and we get 30. But if we can get them above a 15 or an 18% IRR, then that may go to 60-40 or something like that.
All right, we're almost there. 1031 exchange.
Joel?
Okay, you could read it, but I'll just say it from memory.
Yeah.
It's called a like-kind exchange. 1031 is the code in the IRS handbook, and it says that when you sell an asset, that you can buy a similar asset in the market.
Like-kind.
Like-kind. Yeah. And that's a little bit general. It doesn't have to be exactly like, but it has to be generally like. It needs to, be bigger or higher in value than what you sold, and you have to replace the same level of debt. But it's a way to put off paying taxes, the capital gains taxes that you would pay in a general sale.
We've done a show on that. What's a REIT?
Real estate investment trust.
Boom.
Typically buy them on public exchanges.
Yeah, and a publicly traded REIT, and maybe it applies to private as well, is they have to, I think, distribute 90% of the profit to the shareholders.
Real quick, why do REITs suck? Let's just talk about it, because you don't actually own real estate.
Well,
guys, you own a company that has to own real estate.
Yeah.
That's it.
Does the investor get to take any of the
it's taxed way higher. No, you don't get any depreciation in a REIT. It's taxed as dividends.
Yeah, basically kind of like
income.
Tokenizes the real estate investment game into what would be like a stock.
Yeah.
Essentially.
But real estate is amazing because of all of the tax benefits. So if you don't want the tax benefits,
just
buy a REIT.
Okay. Got a couple more.
CapEx and OpEx.
CapEx, capital expenditures, those are big improvements to the property. So we're talking new roof, new parking lot, upgraded HVAC, something like that.
Yep.
Okay. Stabilized property.
A property that is stabilized, generally it's full. Generally the rents are at market or close to it. Sometimes they're above market, but just generally a stabilized, full, normal.
So you have stabilized where you're basically at or above market occupancy, at or above market rents. You just buy it, it's more coupon. And then you have stable or a value add where there needs to be some work done, like what we bought in Texas, and you're going to increase the occupancy and increase the rent by doing some, CapEx type stuff.
By adding some value via CapEx.
All right, we're down to our last term, which is disposition.
This is the sale.
Yeah,
it's easy.
After you've done all this other stuff.
Acquisition, disposition. Just buy and sell. Just fancier words for it.
Boom.
Good catch, Brian.
All right. Well, that was quick and dirty. But, if you're one of our investors, watch this episode so then when we call and we get on the phone, you don't act like I'm talking over your head when I throw out these terms.
Yeah, I try not to use slang in a lot of the emails, but one sneaks in every now and then, so it definitely helps to know some things. Anyway, we'll see you guys next week.
Okay.